Hi everyone, it's Mike DiVita here again. I want to thank you for continuing with your mortgage education. Today's topic, I want to look at an adjustable rate mortgage compared to a traditional 30-year fixed. Now, for full disclosure, I'm not talking about the adjustable rate mortgage that caused the ones that caused the financial meltdown in 2008. Those are subprime mortgages. They don't exist anymore. What I want to talk about are good Fannie Mae or Freddie Mac mortgages. They're excellent loans, and I just want to kind of describe the features of these mortgages. So these are actually 30-year loans. They are fixed for a short-term period, either 3 years, 5 years, 7 years, or 10 years. Okay, now the advantage of the 3 years has better rates than the 5 year. The 5 year has better rates than the 7. The 7's better than the 10. And all 4 loan products have better rates than the 30-year fixed. So it's really up to you to decide, what your goals for keeping the property are and which one of those loans might be a good fit for you to take advantage of that lower rate. Now I want to go right to the whiteboard so we can look at a real-time example. I want to do a loan amount of $400,000. I want to compare a 30-year fixed to a 7-year ARM. And the reason I like the 7-year ARM is because most Americans only stay in their house 6 to 7 years. So right there, it accomplishes most people's goals of keeping a home. The 30-year fixed today, I found a rate of 4.375%. And the 7-year fixed has a rate of 3.375%. So it's a whole 1% reduction in rate for that 7-year period. Now, once again, this isn't a quote for rates. This is just for the purpose of this illustration. Now, the payment on that 30-year fixed, $1,997. The payment on the 7-year ARM, $1,768. So there's the big benefit here, $229 a month for 7 years. That equates to $19,236 over that time frame. You can put it in retirement, invest it in your kids' education fund. There's endless options for that money. Obviously, there's risk involved when that loan becomes an adjustable and you have to deal with the market levels. Is it going to go up? It can go down. There's risk there. So I want to describe a person this might be good for. Think of somebody who's young, buying a starter home. They know their family's going to grow. They know their income's going to increase, and maybe they just want to get into the market. They're pretty confident they're not going to keep that house for over 7 years. The 7-year ARM might be a great loan in order to maximize cash flow and just have a little bit of extra cash to buy that house when they decide to buy up. Another scenario would be an investor. Think about somebody who's buying a property, wants to put some money into fixing it up and then sell it. So why would you go with a 30-year fix when your goal is to sell it within a year? Both of these are great loan products. You need to figure out what your goals are and if you're willing to take the risk to get that lower rate. Now, I want to encourage all of you to check out our California Home Buyers Toolkit, which is on this webpage. It's a great resource for you to understand the buying process, to understand what you should be looking for in a realtor, understanding mortgages and the right product for you, and just basically how to make an informed decision when you come to that point in your life when you're going to buy a new property. If you'd like to go over a comparison of an ARM product to a 30-year fixed, with any loan amount, with any product, you want to go for the 3, the 5, the 7, I'm happy to do that math for you anytime. You can reach me at 1-800-239-1103 or reach out via email at mike@mycahomeloan.com. Thank you and make it a great day.